Okay, part two of the exam today. Let's see what we got. Question 14 is Hall Corporation distributes 30,000 to its sole shareholder EMA at the time of the distribution. And I did tell you that we were going to have these kinds of questions, the ordering rules of paying out distributions where there is earnings and profits. You didn't have to calculate earnings profits, but the ordering rules, I did tell you that, would be potential problems on the quiz. So here we have one. There's earnings and profits of 14,000. The payout is 30,000. That's the distribution. Basis in the stock is 10. What happens from a tax standpoint? So let's first look. What happens is that the 30,000, the first 14 is considered what? A dividend. To the extent of earnings and profits, it's a dividend. That's the general ordering rule. If there is E&P, first distributions are considered a dividend from earnings and profit. Now there's no earnings and profits, so the difference left is 16. That's considered just a plain old distribution. Now we have to look to what's the basis in the hands of the stockholders. That's 10,000 is the basis. Bingo. Since it's more than the basis, it's like selling the stock, although you didn't give up the stock, but it's like getting a return of capital of your basis of 10 and leaving 6 left over, which becomes capital gain. Because you got 6 more than your basis, answer A, capital gain. Which of the following entities is subject to the accumulated earnings tax? Personal holding company. Well, that doesn't mean anything necessarily by itself. If you said personal holding company corporation, I guess technically you could say, well, are they going to be subject to a personal accumulated earnings tax? The answer is no. They'll only be subject to one and not both. So that's why A doesn't work, because it only gets subject to one, not two of them. C corporation, that's certainly the entity that is subject to the accumulated earnings tax, so it seems like that's going to be our answer. S corporation does not have that. It is not a taxable entity in total. We've learned that even in the most recent classes, even if we didn't pay attention to, even if we didn't know that, the fact that we know C corporation we know it from class, is subject to accumulated earnings tax. That's it. Tax exempt, that certainly sounds like a smoke screen. In a certain sense, it doesn't make any sense that it would be subject to accumulated earnings tax, and so it's not, and the answer is B. Number 16, all the following are recognized as reasons for accumulating earnings, except, so we're looking for good reasons for accumulating earnings inside a corporation. Redemption of a stock of a deceased shareholder, yeah, well, that makes sense. We have to redeem their stock. It might be an agreement that we have to redeem their stock. Product liability losses, yeah, well, why not accumulate money in case we have a loss like that? Remember, these things don't have to come to fruition. They just need to be valid reasons for accumulating earnings above the limit and not being subject to the accumulated earnings tax, because it could be reasonable that we might need the extra money, working capital needs, that's certainly a reasonable. So all of the above becomes the correct answer in number 16, because they're all good reasons for accumulating earnings. Whether the IRS buys it, that's a different story, but usually you don't have to have a whole lot of proof. You just have to have good reasoning. Under a plan, and it has to be legitimate. You can't make it up and it's not legitimate. Under a plan of complete liquidation, Coast Corporation distributes land with a $300,000 adjusted basis and a $400,000 fair market value to William, a 25% shareholder. William has a $200,000 basis in his Coast stock. The land is inventory in the hands of Coast Corporation. Coast Corporation must recognize. All right, so this question, some people came to me after class and said this wasn't even in the reading. I didn't go back to double check. I threw this in because I wanted to see if you're getting the thinking process of C corporations and tax law in general. This is really the sooner or later principle. Look what you got here. You got adjusted basis and a fair market value. And what is it? What is it? The land is inventory. Inventory is going to make ordinary income if it's sold. That's what inventory does. And here, we're making a distribution out of the corporation. True, it's in complete liquidation, but it's making a distribution out in order to retire the stock of a shareholder. can this double taxed corporation, so it's two things in general. It's the double tax, the two-time tax of a C, plus the sooner or later tax has to be paid on the ordinary income of the value of the inventory as if it was sold. So the deemed sale principle of the liquidation says that, yeah, somewhere along the line, the value of the inventory compared to its basis should be recognized as ordinary income. Why ordinary income? Because it's inventory subject to ordinary income. And thus the answer is C, ordinary income, $100,000. Number 18, Robot Corporation is liquidated. Again, this was a question that might have been outside of the, or slightly outside of the purview, but I think it was a question that's fair to ask you based on what we did in class. Robot Corporation is liquidated. Marty receiving property, having an adjusted basis of $60,000 in the hands of the corporation, fair market value of $90,000. The property is subject to a mortgage, which Marty assumes. Marty's basis in the stock is $50,000. Marty, now what's Marty recognize? So the question is, what did Marty get? What value did Marty get? Let's look at it. It's very I'm going to say it. I knew it. You knew what I was going to say. It's very simple. Yeah, right. It all sounds simple when you know it. But the idea is to learn through the example and still get a great grade out of the class. That's the idea. Unfortunately, that won't happen. I'm kidding. We'll work it out. Don't worry. So what did Marty get? Marty got land with a value of $90,000. But does it really have that value? It's subject to a mortgage. He's taking the mortgage over. The mortgage detracts from the value of the what he got of the property, and so the real value of the property in his hands is only $10,000. What was his basis? $50,000. He really has a $40,000 loss because he's worse off now than he was before. He had a $50,000 basis, but he didn't get his basis back. All he got was the value of 10. That's all he got back, the value of 10. $40,000 loss. Answer B. End of discussion. All right. True or false? C corporation must use a calendar year. Definitely false. We learned that. It has the ability to choose of all entities out there. The C corporation has the ability to choose any year it wants without penalty, without problems. Corporations are permitted to deduct $3,000 in net capital losses annually. I think we tried to emphasize that a heck of a lot in class. Definitely false. Only can use capital losses against capital gains. End of discussion. Section 351 applies to exchange if the contributing shareholder owns more than 50%. No, we learned that's 80%. False. End of discussion. Any losses? Now I'm going to take the heat on this one. I'm probably going to take the heat on all of them, knowing my wonderful students, which is fine. You're all wonderful students. But this one said any losses on the sale of Section 1244 stock are ordinary. It's true. Losses on the sale of Section 1244 stock are ordinary, but it's up to a limit. It's up to the limit of $100,000 for joint taxpayers or $50,000 for single individuals. The amounts over that become regular capital gains. The textbook was clear on that. We talked about it in class. We talked about the limits in class. I think there was some slight misunderstanding when a question was asked in class, but that was clear that it's not just any losses, it's only the limitation. Okay. That takes care of the review of the test. See you Wednesday.